There we go. Welcome, everybody, and happy Wednesday. Welcome to the Waterview review. We're proud to present this asset and excited and to have another collaboration with Velocity Capital. This is a 295 unit Class A community in Richmond, Texas. So let me get the disclaimer out the way. This is not a solicitation for an offer, and any such solicitation will be granted via the PPM and subscription agreement. So please familiarize yourself with this documentation. Once you're happy to invest, you'll sign the appropriate SEC approved documents. So a little bit about us. I'm Viano Joseph, CEO and co-founder of Dreamstone. We own and operate over 1,400 units in the Sunbelt region. Prior to launching Dreamstone, I was a auditor with Grant Thornton, and I'm originally from Cape Town, South Africa. Worked primarily on Fortune 50 companies and have done mergers and acquisitions in excess of $5 billion in my tenure. I'll have Nick introduce himself.
Hi everyone, Nick and Tessa, Chief Operating Officer and co-founder of Dreamstone. Prior experience is I used to work for a home builder for a few years, worked my way up from literally laying concrete all the way to working in the corporate office with a team of 6 underneath me. And then have had some prior experience building racetracks for IndyCar before that. So then I'll turn it over to Steve.
Nick, that's a fun fact. I didn't know you did the IndyCar thing.
Yeah.
Cool. So Steve Breton here. Been in real estate for coming up on 10 years now. Prior to that, I was putting my MBA to use in IT management, in banking and pharma companies. I've done about $500 million in real estate transactions, and I'm also guest lecturing every year over at Babson College, where I got my MBA. That's in the real estate transaction course. All right, so jumping into the case study. So we're just going to show like 4 of these quickly, spend less than a minute on each of them. So this is Timber Hill, collaboration between Dreamstone and Velocity Capital. Picked this asset up earlier this year, 340 units. Similar to the Waterview, we bought this directly from the developer. We're going through and releasing all of the units. Everything's going exactly as planned. Wonderful asset. We're thrilled to have it. You jump to the next one. This is Cross Creek, purchased in September 2020 during COVID. Got ourselves a nice little discount on this deal. We're currently cash flowing very well. Haven't even really done a lot of the upgrades that we had planned to do, only because we continue to raise rents to market levels. And whenever we do an upgrade and test market, it's going really well. And we continue to get unsolicited offers from people that want to buy the property. So great little asset. We're going to hang on to this one for a while. Next. And the Peach in Atlanta. So this was an office building, essentially. 12-story mid-rise. We went through and did full renovation. I mean, literally got rehab, elevators came out, everything. It's now multifamily, Class A, cash flowing well, beautiful asset, and we're about to refi the investors and get them 100% of their equity back. And lastly is Polaris Harbor. This was one of the early projects we did together. We've actually done a couple just prior to this one as well, but this one we just sold, and you could see the IRR numbers, and the projected IRR was 68. Actually, I think that was supposed to be 18. I'm sorry. Yeah, actual is 68. We had projected 17, 18%, which is what we do on all of our projects for the most part, knowing that we were going to outperform a bit, but the Tampa market absolutely blew up. So we got 68. And the annualized returns for investors is over 100%. And a lot of the investors in this deal are actually going to 1031 directly into the Waterview with us. And I already saw a question in the Q&A, which we'll address later, but about what the 1031 looks like. So now this is the Waterview, 3 to 5 year hold. Again, annualized return 21%, target 16 to 18%. So that's based on our underwriting. We try to be fairly conservative in the underwriting, and Vahana will mention a few points later as to how exactly we are conservative. I'm not going to spend a lot of time on this slide. Go ahead and jump to the next. And here, simple enough. It's massive job and population growth, high income, expensive housing, and then supply and demand imbalance, which I don't think we don't have it listed here, but the imbalance in this market, in many of the Texas markets, is enormous. You can't build housing fast enough. You can't build apartments fast enough. And this happens to be right in the path of progress. So it's really all the great ingredients that we want and need in order to have continued multifamily profitability.
Excellent. So I'll do the quick executive summary, just kind of highlighting what, kind of how we got this project. This is a project we're buying directly from the developer. They specialize in retail development. So they primarily develop HEB anchored retail centers. And so this happened to be one of their projects where they have 134 acre retail center where typically they would sell off this land, and this was one of the projects that they actually decided to keep and build. So what we like about this is we're buying from them at a discount below what we could build it for today, so below replacement costs. And we're in that suburban pocket, which is so huge in this kind of market where we've become so used to comforts of being having things delivered to your house, and working from home, and having that convenience of retail within walking distance is huge. So we'll do pretty well with getting the right tenant base here. A couple of things to highlight: the preferred rate of return will be distributed 6 months quarterly after we've reached 90% occupancy. The reason for that is we're in lease-up mode right now. The property, when we started negotiations, was at 20% occupancy. Right now, we're actually, as of today, actually at 52% occupancy. So it's had an incredible lease-up period. And we're pretty excited to see, by the time we close this transaction, where we land. But there is a value add component to this. The value add is taking it from 50% to 100% leased, and then actually adding some additional smart locks and thermostat packages that we did at Pilar's, just to give it that enhanced sophisticated living package. I think that's gonna set it apart from the rest. So that's something we're going to look at adding. Again, can't stress this enough, close to major demand drivers and local employers, and also the affluent nature of this neighborhood, with a household median income being over $126,000. And with that, we're going to have Nick chat to us about the construction.
Yeah. So here you can see a nice aerial photo of the Waterview. You can kind of see down in the bottom left there the LA Fitness right next door, and in that kind of center there's a Texas Roadhouse, there's a Chick-fil-A, and then kind of like right down the street a little bit is an HEB grocery store, and there's a Kroger right down the road as well. So we've got like a lot of great retail amenities right in the area that kind of help drive more traffic to that area, more walk-in potential and everything that would be great for our leasing team. So if you want to go to the next one. So the property, itself has world-class amenities. Steve, myself, and our property management team walked them a couple weeks ago. They were partially built out, about 50% done or so, but if you have a good vision, you can see that's going to be absolutely beautiful. So resort-style pool, cabanas with a grill, a massive clubhouse that can be rented out for events, the fitness center with a spin room and a sauna in it as well. It's a game room with a pool table, arcade style games. Then a couple options for the residents. You know, they can upgrade to covered parking or have their own parking garage, which would be great. It's a nice little fee there for us as a additional source of revenue. And of course, those of us who have pets, you know, there's a great little dog park and dog washing station, which would be perfect for those. As of right now, all the buildings are weather tight and all the crews are working on finishing the interiors on the remaining units. Some of the nice features, you know, there's quartz countertop, LVP flooring throughout. All the units have stainless steel appliances. They're all Whirlpool packages, so everything matches, and it's really nice. Every unit, pretty much every unit has a computer niche, because obviously most of us work from home now. So the developer had the foresight to kind of implement that into their layouts, which is great. There's also some built-in closets, and all the units are going to come with some type of form of like a patio or a balcony or a private yard. So here, you know, with the site map, building 4, that's the leasing center, the mail room. This building is fully occupied. Building 2 to the right, that's also fully occupied. Building 3, that just finished a couple weeks ago, so there's residents moving in there as we speak. And then building 5, that's the amenity building with all the amenities that I mentioned, plus the pool, and that's getting pre-leased for September move-ins. So we're excited to get that one filled. And then I'll talk about the construction schedule in a second, if you want to go to the next one. So here's all your 1-bedroom layouts. My personal favorite's A5. 2 bedrooms, they're really big, 2 bedrooms. I really like the B0. That's probably my favorite layout there. So you go to the next one. So here's the construction schedule. Even with all the supply chain issues that have been in the news for like the last year and a half, you know, the construction timeline has been managed very well by the development team, and they've actually stayed very true to the projected timelines that they've been giving us and everything. And so that's really exciting for us. And so building 5 should be completed hopefully next week. We're going to get an update tomorrow to see exactly when that one's going to be finished. And building 6 and 1 are going to be right behind it, about 20-30 days in between each building being completed. And so with that, I'll pass it back to Fiona.
Okay, thank you, Nick. So again, we want to look at some of the highlights of why we love this transaction, and I can't speak enough about the market and the location. So let's dig into that. As Nick was alluding to, the Waterview Town Center development over here, which includes the Target, the HEB, Marshalls, LA Fitness, Chick-fil-A, all of the retail that you would pretty much ever need. One thing that's been a huge driver of progress in Houston has been Texas State Route 99, which basically creates a loop outer loop. They have an inner loop. This is the outer loop that they've created, and it connects the south to the north, and just gets you to your employer very quickly. And has been huge to the growth in these regions. And something that we really like is that the housing in the immediate area are all above $500,000, which we'll talk about affordability later. I think that's key for keeping the demand in the multifamily space. Another thing about the affluent demographics, we're looking at the 1 mile radius median incomes is 125,000, 3 mile 123, and 5 miles 115. So really strong demographics as it relates to income. When you look at what those people are shopping at, what are they buying, all the demand drivers that those folks are going to be doing, and there's going to have to be employees and support staff, and it's really exciting to see that people in this upper bracket. And I alluded to it earlier, the affordability buffer, which I think is pretty important and key as we move into a recession. With interest rates going up and mortgages becoming more and more expensive. This slide's probably outdated now. We're at 5.75 on average. and that average monthly mortgage payment is $2,600. We're targeting a $1,700 rent payment on average effective across the whole unit mix. So there's an affordability buffer that Waterview will enjoy, which will then increase. If you're gonna rather spend $1,700 instead of you wait for the market to normalize potentially, or if it ever normalizes. So well, it's pretty huge for us to have that, and it's testament to see that in the demand and the lease up velocity that we're seeing, going from 20% to 50% in like 3 months. It's fantastic. Employment, I've always thought of Houston as a bit of an oil and gas hub, and rightfully so it is, but I think over the last 15 years it's really diversified, and it's really impressed me what seeing the almost 400,000 different jobs in the immediate within a 11 to 20 to 30 minute commute time, which is it's huge. We typically hire for our employees, we look at is that employee within a 30-minute commute time, and that's always that keeps a happy employee, especially if they have to go in and they can't work remote. So having access to this amount of jobs is excellent. More specific to the local submarket, Fort Bend is where this property is located. The greater Houston area is in Harris County, which is much of it is in a flood zone. Fort Bend is towards the west of Houston, not in a flood zone, thank goodness, and we're a little bit more business friendly county, as we'll see later on the taxes. We have some exciting companies coming in here. Tesla's coming in. There's a huge Amazon fulfillment center with 3,000 employees. The medical centers, it's a very diverse employment base in this local submarket. So that's how I felt comfortable with Houston, and just it really it's nice and diverse. It's not just one type of employee out there. So you've got to be thinking about those risks as we move into this recession. Just some highlights about where the property is compared to downtown. Very close. 99 loops around the city, so we have the inner and then the outer band. So really has pushed that path of progress out to the west. And get into my favorite financial information. All right, so we in our underwriting, we're predicting or performing roughly 3% rent growth. With the tailwinds we have in real estate today and inflation, we think that's going to be significantly higher. According to Axiometrics, they forecasted for 2022 it will shake out to about 9.9% growth from last year. And then next year 5.3%. So I think there may be additional upside to capture there. Expense growth we've set at 3%. Fort Bend on the tax reassessment has typically been 60 to 75%, 65%. We've confirmed this with Collier, some of the underwriters over there, and some of our local investor friends that own property in this area. So with that being said, we're trying to alleviate any surprises. So we're reassessing the taxes at 80%. With this being a lease up, we will also be holding a debt service reserve for 18 months. And so you'll see that illustrated here below, us applying that debt service. So as we close the transaction, we fund that debt reserve, and that goes out and applies to the debt service as we execute our business plan in the lease up and stabilization of this property. A few highlights here just on the source and uses. So again, we're looking at $73.3 million transaction. Purchase price is $63 million, 200, which is $215 a door. Again, today we cannot build that same product. I think we've heard some people saying 255,000, some folks are saying 280,000 landed with the disruption in supply chain. So, as we look at some of the key indicators and key things that are hurting us as apartment investors, that's the risk of execution, and buying these things pre-stabilized, already ordered containers on site, and they're finishing out everything, is a way that we eliminate all of the construction execution risk and get delivered to us a complete package that we can then go out and stabilize. So, this is not a new strategy of ours, but it's something we've done now several times, and it's really, really great. Cap rate sensitivity, just to talk to, stress testing. The typical cap rate in the Houston MSA was about before this, in the heyday, it was about 3%, maybe 3.25%. As of H2 2021, on the CBRE cap rate survey, it was 3.75, and we're underwriting to a 4.5 cap on the exit, so a $90 million exit. And this table just illustrates if we miss by 15% or if we improve by 15%, what that looks like in terms of IRR. Again, we're not losing any capital if something horrible happens, like we end up at a 5 cap. The likelihood of an A-class property being valued at a 5 cap is next to remote, and I mean, if that's happening with C classes, are like 20%. So typically they stay in that lower sub 5, sub 4 range. The reason why we love real estate so much is depreciation. So we're doing a bonus depreciation cost segregation study on this property. Our engineers indicated it's going to be roughly about a 62% bonus depreciation just by moving depreciation from the 27.5 to 5-year and 15-year buckets. So what that means is you can look to write off about 62% of your investment in year 1, which would then shield any income coming out there, which is excellent. We've also split the classes again in this investment vehicle to a class A1 and a class A2. You get a 7% preferred return if you invest $50,000 to $499,000. Anything above $500,000, you get a 9% preferred return. So rent comps, let's talk about the unit mix. Again, the way I look at this is where our in place is $1.69 and we're moving it to $1.76, which, that's just a testament to the market being pushed, and us capturing that market. Again, I'll illustrate this later, that we're not at the top of the market, but we're not at the bottom. So, it's very nice to have that loss to lease that we can burn off with doing pretty much nothing to the interiors, which is great. Here's some highlights about the rent growth that Axio Metrics is forecasting. So we're looking again next year at 5.3. We're underwriting a 3%. The rent growth and population growth has been phenomenal in this area. As illustrated here over the last couple of years. And as for a supply pipeline in a 5-mile radius, we're not in a position where there's a huge delivery of apartments. Again, like Steve mentioned earlier, even though the absorption rate has been phenomenal in Texas, that you can't build in fast enough. So again, we're not worried about any of the things coming online, and in fact we're already at 50%, so it's great. Some of the rent comps, our main comp is Granary Flats, I would say, also being delivered at the same time. And just to illustrate, we're moving our one beds from $1.82 per square foot to $1.94, which again, not at the top. Granary is $1.98. So, you know, in other Alora Bella, $2, $2.11, $2.34. Two beds, again, same thing, moving it from $1.65 to $1.69 on average. Again, Granary Flats, $1.86. So there's enough room, you know, for future appreciation there in rental prices.
Yeah, Vahano, if I can jump in here, the average household income is, you know, that's really why that metric is so important when you're trying to raise rents. You're looking at not exceeding more than 1/3 of their annual income, and in this case, we're below 20%.
Right.
So there's a massive amount of room there for us to grow rents in the future. Not that we're in a rush to or anything, but if the market continues to grow, this particular tenant class is able to continue to absorb those rents.
Right. Sell comps. So again, I think we just got this thing at a fantastic basis, 215 a door. Recent sales, you know, north of 280,000 a door, which, you know, we think, you know, in a 3 to 5 year span, we would easily, you know, be above that, because, you know, of having newer properties. A lot of these were older properties.
I get excited every time I see that slide.
So yeah, questions. Before we go to questions, if you're ready to invest, go to our website, dreamstoneinvest.com, click the investor portal, sign up for your account. If you have an account, all you got to do is log in, click invest, fill out the questionnaire, and you'll be able to get your commitment in and get your wiring instructions and signatures and all of that in the portal as normal. So Steve, if you can help me with the questions.
Yeah. So I'll just rattle them off here. So what happens if the property stays below 90% occupancy?
We would, if anything like that was happening, and as it's most likely as a result of higher rates, we would just adjust our rent rates to, or adjust our bonus concessions to get more traffic and get it above that 90.
I think it's also important to note, I don't think we covered this in the deck, that the break-even occupancy at today's rents, just what they're currently leasing at, is 74, 73%, Vahano?
74%, yep.
Yeah, so, you know, we could get down to the point where we only have 74% of the property filled with paying tenants and still be paying all of our bills, the loan, everything. I mean, during COVID, sorry, not COVID, 2008 housing crash, right? When the literally houses were worth next to nothing in some markets, very little in other markets. So people weren't renting as much, they were just buying houses. So that was like the worst of times. And occupancy levels in Houston and San Antonio, in other Texas markets, were still, I think, in the high 80s, like 88, 89%. So it would really have to be an ugly scenario for us to be below 75, certainly.
Yeah.
All right, next question. Any rent control pressures in this market?
Texas, no.
All right, that's one of the reasons
why I like it.
There was a question of, what if the property is not fully built when it's time for us to purchase it?
So good question. We have a facility with Ladder Capital, which also we haven't really spoken about the debt. This is a unique debt product that was specifically designed for us. It's a fixed rate bridge product, so you know, we can close on the property whenever we want. What we've established in escrow is, as each, the way they are delivered is by building. Each building gets a certificate of occupancy. If they don't provide us that certificate of occupancy, they don't get that that portion of cash. So it's kind of a holdback, if you will. So it's a performing mechanism for them to complete and execute so that we can actually, they can get paid. So for everyone that has a CO, they'll get that on closing day, and then subsequent will get the certificate of occupancy, and then funding will get sent through.
So essentially, we are only paying for what is complete, and the
Yeah.
units that aren't complete, we're not paying for those at all. And if we need to bring somebody else in to complete them, that would be the absolute worst case. We have the money to do so.
And Reed King is the developer. They're highly reputable developer. They do HEB anchored stores. So just to have that relationship in itself, it's like having a Publix. If we have folks from Florida or Trader Joe's or whatever, having that relationship to go out and build exclusively for them and those retail development centers around them. So they, it's been awesome experience with them thus far. This is their first project where they're fully at the helm. Interesting enough, we're already in talks on their second property, which is going to be in Katy, which is next to a $70 million high school facility. So again, in that path of progress, and that kind of not path of progress, but that actual demand drivers. So we're excited to be partnering with him.
Okay. At what point do we expect to be at 90% occupancy?
So we're looking, we're modeling out roughly about 6 months after close. So, anywhere in May, I think it's May of next year, we're looking at being at 90, just to give the property some time to get to full stabilized occupancy.
Yeah, and if you look at the current lease status, it's like 5 to 10 leases per week that they're signing, right?
Yeah.
Yeah, and we're currently 50% occupied at the moment. Sorry, 50% leased, 29% occupied. Is that right? 50,
yeah.
53 and 29, I think.
52. Yeah.
I mean, it changes every day. They're leasing like crazy. So, they're going to be a bit ahead of schedule if they keep it up at that rate. Okay, what else do we have here? All right, this is a good one. You don't get this one very often in these webinars, but it is a question that I hear all the time when I'm talking individually with investors. And that is, what exactly do I own once I buy into this deal? Do I own a unit? Do I own partial of every unit? How does that work? And Vahano, I'm happy to take that one.
Yeah, go for it.
So basically what we're doing here is we're buying the property in an LLC. That's what syndications are. So we buy it in an LLC, and then you do a mini public offering is what it amounts to. So we work with securities attorneys, and we're selling units or shares of that LLC. So for every $1,000 or $50,000 or whatever you put in, you're getting pro rata ownership of the entire property, which also means that you're now entitled to the economic benefits, meaning cash flows, depreciation, and then the capital gain at the end when we sell the property. So it's all based on how much you put in, but you'll get your pro rata share of all of those things. And I had 2 questions here just prior to starting. A couple of investors had sent me. Why is the developer willing to sell at such a discount?
Yeah, so good. That's a great question. The reason these are retail developers and also merchant developers, meaning they don't hold, they develop and sell. And with their start of this project, they started this in December of 2020. So you imagine you're procuring all of your goods, your material, they're getting everything ordered, fixed in their contract, shipped over in containers and delivered in time on site. So their cost when they started the project is significantly lower than what it would be today. So they're still making good money at 250, and there's no distress or anything like that. What it comes down to is, can I sell my property today or do I have to wait to stabilize and lease up? And for them, they're going to take the sure thing now, and so that's how we've negotiated a discount from 265 a door down to 215 a door. You know, when we started this whole negotiation with them. So, you know, I think it's important to understand who your seller is, and our seller here is a you know, call it merchant developer.
All right. Question about distributions, quarterly or monthly?
Quarterly.
And how much job diversity is in the surrounding area? Any that have more than 25% control?
No, there's not. It's so diverse. One of the slides we don't have on here, but it's in the offering memorandum. You'll see pinpointing all the different employers, all the different types of employment there. So, I mean, we're looking at, you know, anywhere just on the major metros, we're looking at, you know, 600,000 different jobs from different sort of institutions.
Okay, and then there's a question here. Is there a promote sponsor to the GP or just a 70-30? I think what they're asking about there is there a waterfall beyond the 70-30 structure?
Yep, absolutely. So in the PPM, you'll be able to see the waterfall. What we're doing in this one, it's 70-30 to 7 or 9, depending on your class. And then the next tier, and Steve, keep me honest here, I think it's 18.
Yeah,
18, 50.
it's
then
17.
17, and then we'll split up to 17, and then after 17 it's 50-50.
Yeah, so the preferred return, you know, that's going to happen either way, so not too concerned there. It's the 70-30 split up to 17%, and then that's on the IRR, so call it an annualized return of like 20%.
Right.
In that ballpark. So after that, it's 50-50 split on everything beyond that. And in the past, we didn't always do this. Actually, most of our deals, we didn't do it. And then when we exited things like the Polars deal that we showed earlier at 100% annualized return, we realized, well, you know, the partners could have done a bit better in that. If investors got a 80% annualized return, 70% annual, they still would have been, you know, beyond excited. So we thought that was perfectly fair, you know, with all the effort that we put into these projects. I've personally exited a couple of other deals as well in the past 2 years, and the same thing, just enormous returns for investors. And, you know, we did pretty well as GP, but we figure if we outperform by that much, you know, we'd like to do a 50-50 even split at that point. And one more, any opportunity for significant value adds once it's fully occupied?
Yeah, I don't think this is not a project where we'd want to hopefully the tenants don't destroy the units. That would be the only extreme case. But no, I you know, these are quartz countertops, stainless steel appliances, LVP flooring. Would there maybe some opportunities on some landscaping or you know, some maybe fenced in yards if we had to go down that route? But I think this property is beautiful enough. It has all the amenities. They really they've knocked it out the park on the design aspect, and even the comps in the area. All the properties are really well amenitized. So I don't, you know, it's one of those things where we're buying and holding and exiting, you know, just by enjoying the tailwinds that we have in multifamily, and that's going to continue due to, you know, what we're seeing here with inflation and things going on.
So I have a question about the 1031 here. There was an earlier question by Cliff. When will we know exactly what our 1031 distribution amount is? And I responded to Cliff. Anyone who goes to the QA can see the answer there. I basically responded, said that we can tell you exactly what that is. But for an investor who put in $100,000 into Polaris Harbor, 2.5 years later, you're now at $270,000. That's the amount that of the ownership value that you'll have in the Waterview. So you went from 100 to 200, I think it's 273 and change, but
Yeah, it's some change. Yeah.
And
And for the 1031 folks, what we'll have here shortly is we'll assign your investing entity that you used in Polaris to a new entity. It's called PHV Waterview. So you don't have to do anything on your end. The money is already with the qualified intermediary, and that will just get sent to the closing table. We will assign your entity in this in the portal, and your distributions and everything. You'll see your exact share in there.
Thank you for all your great answers. What is the timeline for this investment? Time frame? And I think we're talking about executing documents and wiring.
Yeah. So overall timeline, our drop dead date is 10/23, October 23. We're looking to have everything finalized, signed, wired by the middle of September, hopefully by end of September for the latest. We have a significant amount of demand, and I've already have a lot of people that have signed up. So this is a first come, first serve investment. If you're interested, it's going to be that person that wired the money, signed the documents, and that's who's going to get in here. We're trying to build our pipeline, so we've got several other deals. So we won't leave you without the next transaction, but yeah, I would urge you to do that sooner rather than later.
All right. How do we subscribe and receive the PPM for review? You want to show your screen again on that last page?
Yes. Can you see my screen?
Yep. So basically just go to dreamstoneinvest.com and you'll see that banner at the top, and just click on the investor portal.
Yeah. Once you
get in there, you'll see everything.
Yeah, it will prompt you to create an account if you're a new investor. Once you create your unique account, fill out a few security questions and secure your account, and you'll go to current offerings on your left, and it'll have all the documentation you'll click the green button to invest, and it'll take you through the signature screens as appropriate.
I think that's the last question.
Excellent. Well, yeah, so it's kind of weird doing the webinar without people talking to you. Thank you all for taking the time to join us this evening, and we hope to see you enjoying this asset with us and the future assets with us in Texas. Yeah, if you have any questions, feel free to reach out to myself, Nick, or Steve, and we can help you get set up on the portal and answer any questions you may have. Yeah, have a wonderful evening.
Thanks, Vano. Thanks, Nick.
Thank you all.
Thanks, everyone.